Hello everyone. Welcome to Kotak Wealth's market update for the month of March. I'm Srikanth and with me is my colleague Shobhit Mathur. Hi Shobhit.
Hi Srikanth.
Shobhit, looking back, last year was supported by a very strong surge of liquidity which supported the equity markets. How do you think this year is going to pan out?
So effectively last year's liquidity flow supported weak fundamentals, but as we look to see the growth coming by this year, there are 2-3 fundamental reasons which make us believe that market should remain supported. First and foremost, at a credit growth level, we are seeing significant amount of demand come back again, and large and medium enterprises looking back to raise money from banking system. We're already seeing 11% plus growth coming by. We're also seeing cement production grow more than 20%, which is a clear indication of the amount of infrastructure spending that the government is building in. You also look at overall CV sales, and that number is also showing very strong signs of more than 20% growth coming by. So these are strong fundamental lead indicators suggesting that the economy is on the turn. If you look at the other point regarding liquidity, and we spoke about the domestic liquidity supporting the market in the last year, even the last 2 months where markets started to be a little jittery, did not see significant reduction in the number of new applications coming into mutual funds. In fact, in terms of numbers, we have hardly seen about 5% reduction in the amount of flows which are coming into equity mutual funds if we adjust for a certain amount of arbitrage funds and other category of funds which are not necessarily equity. And old investors who would have looked to maybe redeem out of their investments at the sign of a turn of the market haven't really seen huge amount of redemptions come by. We've only seen about 2.5% extra redemptions happening in the month of March versus the previous months. So all in all, I think economy seems to be turning around and flows still seem to be supporting the domestic liquidity.
So Shobhit, sticking to the point of liquidity, we all know that FIIs have massively shorted Nifty in calendar year 2018. Figures estimate it to be close to $1.2 billion. We see the emerging markets being caught in the crossfire of the ongoing trade wars. We might actually see a liquidity squeeze happening because of $30 billion of equity raise in India, which is where your local flows can get channelized into. And of course, the recent sort of guidance by the Fed that they could raise US interest rates to 3.5 over the next 2 odd years. How does that augur for an emerging market like India?
Yes, you're absolutely right that FII flows are going to be a critical part to the market dynamics this year, especially because it's also an election year in India. However, let me point out to the fact that the trade war that you referred to in your discussion is not really something which significantly impacts India, because India just has about 1.5% of its GDP which comes by way of exports. So versus most of the other global economies, India doesn't get impacted much to that extent. However, having said that, I think we still are expecting more than 20% earning growth for the next financial year and close to about 16 to 18% earning growth in the year following to that. So to that extent, till the time Indian corporates are able to continue to grow their earnings, foreign capital will continue to keep looking at India as one of the key growth markets. And I think that will keep continuing to attract more and more foreign capital into India.
So Shobhit, given all our headwinds and trends, what would you recommend for equity allocation for our investors?
So even after the correction, we don't find comfort in going after mid caps yet. We continue to maintain our bias towards large cap mutual funds. And of course, on a selective basis, we have maintained an approach to look after managed strategies where one can build portfolios with a slightly longer horizon in mind and buy individual underlying stocks with boutique managers. Having said that, we also look at risk-adjusted strategies which can help people navigate the volatility that the market is going to offer in the next 12 to 18 months.
So Shobhit, talking of interest rates, how much do you think will this recent 30 to 40 bips compression in yields is likely to sustain? You've seen Government of India sort of back-ending their borrowing calendar. They've reduced their first half borrowing calendar by as much as 50,000 crores. But despite that, we are not seeing demand coming back to the table. FIIs, which were almost at $26-27 billion of net buyers last year, have actually turned out to be net sellers of the Government of India paper. So keeping these two factors in mind, do you think that the recent rally in the bond yields in the month of March is even sustainable?
So to that extent, I think government seems to be reading the mood of the market, and they did take some preemptive actions before the end of the year to ensure that they smoothen out the impact of the higher interest rates which one saw in the last full financial year. Having said that, I think the market is still not very sure of how this borrowing eventually is going to pan out. Government has talked about moving some part of the borrowing to some of the small saving instruments and also shifting a large part of their borrowing to the second half of the financial year. However, having said that, given that this is an election year, one keeps doubting the way government is actually going to pan out its borrowing. Thankfully for the government and for the RBI, inflation print seems to be still under control. February print was around 4.4%, which gives RBI room to measure their approach in the next financial year. As of now, it will be interesting to see whether RBI continues to prefer the growth target versus the inflation target, and if they can give the market a little longer rope, it should help sustain the market nerves and get some demand back on the table.
So Shobhit, the other big concern going forward will be the fiscal deficit for the year coming ahead. One of the key ingredients for the revenue for the country is the GST revenue. And so far the GST revenue hasn't been on the mark. As against an estimated 1,10,000 crores run rate, we are currently at about 90,000 crores. How do you think that will in turn sort of shape what lies ahead for us?
So you're right in the sense that Centre has missed their estimates by a big mark against their own estimates of about 50,000 crore collection month on month. They are clocking close to about 23,000 crore for themselves. That's one of the reasons that they've introduced the e-way bill starting of this financial year. Hopefully that should help them bring up those numbers. Having said that, I think at a state level, the passing on of the GST revenue has been quite commendable. And to that extent, at a state fiscal deficit level, the number seems to be falling down consistently, and we expect that number to reach closer to 1.9% by the end of next financial year. That's the reason that the state government bonds have seen their yields compress by about 30 basis points from a spread of 90 basis points above the government yield to about 60 basis points currently. Having said that, I think the uncertainty around the interest rates is going to continue for the next financial year. And given the fact that most of our fixed income investors are looking at a 3-year horizon on their mutual fund investments, we prefer to recommend to them to maintain short duration investments which match the investment horizon for their portfolios. And to that extent, accrual strategies with a 3-year horizon are the ideally suited recommendations for any fixed income portfolio.
Thank you, Shobhit, for sharing your insights on the key highlights for the month of March and also our outlook on the month of April. With that, friends, it's a wrap on this month's market update. Do write into us with your feedback and see you all next time.